There's a number that keeps appearing in conversations with the smartest precious metals investors I know. Not 100 ounces, not 10, 50. And when you understand why, everything about the silver market suddenly makes sense in a way it never did before. Let me show you something that's been hiding in plain sight. The silver market just experienced one of the most violent moves in modern history. We're talking about a metal that surged over 140% in less than 18 months, then crashed back down in a matter of weeks. But here's what nobody's talking about. During that entire roller coaster, a specific group of investors didn't panic. They didn't sell. And they're not worried about what comes next, because they understand something about 50 ounces that changes the entire game. Think about this for a second. When silver was trading below $30 per ounce, most people thought it was expensive. When it crossed 70, they thought they'd missed it. When it touched 90, they were convinced it was a bubble. And when it pulled back, they felt vindicated. But the investors who accumulated 50 ounces or more during the climb, they're sleeping just fine. And I'm going to show you exactly why. The 50-ounce threshold isn't arbitrary. It's not some random number pulled from thin air. It's the mathematical intersection of three critical factors that most investors completely miss. First, it's the minimum position size where silver's volatility works for you instead of against you. Second, it's the exact amount where storage and liquidity concerns disappear. And third, it's the psychological sweet spot where you have enough exposure to matter, but not so much that you're overextended. Let me break down each of these, because understanding them is the difference between treating silver like a lottery ticket and treating it like the strategic asset it actually is. Start with volatility. Silver moves. We all know this. It's the most volatile major precious metal, and that scares people. But here's what the data actually shows. When you hold less than 50 ounces, every $5 move feels catastrophic. Your position is small enough that the dollar swings seem huge relative to your total investment, but not large enough to actually change your financial situation. You're in the worst possible position, feeling all the pain of volatility with none of the upside potential. But once you cross that 50-ounce threshold, something interesting happens. The same $5 move that felt devastating on 20 ounces suddenly feels manageable on 50. Why? Because you've reached the point where your position size justifies the volatility. You're not gambling anymore. You're positioned. Now let's talk about what just happened in the market, because this is where it gets really interesting. Silver went from the high 20s to over $90 per ounce in what felt like a blink. The move was so fast, so violent, that it caught even seasoned traders off guard. Central banks were accumulating, industrial demand was surging, investment demand was going parabolic. And then just as quickly, we saw a sharp correction. Silver pulled back significantly. Gold gave up some gains too. And the financial media immediately started writing obituaries for the precious metals bull market. But here's what they missed. The investors who held 50 ounces or more, they didn't sell, they didn't panic. Many of them actually added to their positions during the pullback. Why? Because they understand something fundamental about silver that the short-term traders don't. They know that silver's true value isn't determined by weekly price action. It's determined by the structural deficit that's been building for 6 consecutive years. Before we go further, I want to mention something quickly. If you're watching this and you're thinking about how to protect your retirement savings from everything we're seeing in the markets right now, I put together a free guide that shows the exact strategies thousands of American retirees are using to safeguard their wealth. It's in the description below. No cost, no obligation, just practical information that might be relevant to your situation. All right, back to why 50 ounces matter so much right now. The Silver Institute just released their forecast, and the numbers are staggering. Global silver supply is expected to reach over 1 billion ounces, which sounds like a lot until you look at demand. Industrial demand alone is consuming more silver than we're mining. Solar panels, electronics, electric vehicles, 5G infrastructure. Every major technological trend of the next decade is silver-intensive. And that's before we even talk about investment demand, which has been running hot for years now. Here's where the 50-ounce position becomes critical. When you understand that we're in a structural deficit, meaning we're consuming more silver than we're producing year after year, you realize that price volatility is just noise. The long-term trajectory is set. The only question is timing. And 50 ounces gives you enough exposure that when the next leg up happens, and it will happen, your position to actually benefit in a meaningful way. Let me tell you about something that happened during the last major silver bull market. Back when silver went from single digits to nearly $50 per ounce, there were two types of investors. The first group bought 5 ounces here, 10 ounces there. They were dipping their toes in. When silver started moving, they made some money, but not enough to change anything. They sold early, took their small profits, and watched the rest of the move from the sidelines. The second group? They had accumulated 50 ounces or more before the move really started. When silver doubled, their position doubled. When it tripled, they had real wealth creation happening. Same market, completely different outcomes, all because of position size. Now I know what some of you are thinking. 50 ounces sounds like a lot. At current prices, we're talking about a significant investment. But here's the perspective shift that matters. Think about what 50 ounces actually represents. It's not 50 separate bets on silver. It's one strategic position in the most undervalued monetary metal in history. It's a hedge against currency debasement that's happening in real time. It's exposure to industrial demand that's only going to accelerate. And it's a position size that actually matters if you're right about where this market is headed. The storage question comes up a lot, and it's worth addressing because it's part of why 50 ounces is the magic number. Below 50 ounces, you're probably keeping your silver at home, which is fine, but it creates this psychological burden. You're thinking about security, about insurance, about what happens if something goes wrong. Above 100 ounces, you're definitely looking at professional storage, which adds costs and complexity. But 50 ounces? It's the sweet spot. It's manageable to store securely at home if you want to, but it's also substantial enough that professional storage makes sense if you prefer that route. You have options, which is exactly where you want to be. Liquidity is the other piece of this puzzle that people underestimate. When you own 5 or 10 ounces of silver, selling is easy, but the transaction costs eat into your returns. Dealers have spreads, and on small quantities, those spreads are brutal. But when you're selling 50 ounces, you're a serious seller. Dealers compete for your business. Your per-ounce transaction costs drop significantly, and if you ever need to liquidate quickly, you can do it without taking a massive haircut. This matters more than most people realize, especially in volatile markets. Let's talk about what's happening right now with the banks, because this is where the 50-ounce strategy really starts to make sense. JP Morgan's research team just revised their silver forecast upward significantly. They're now projecting much higher average prices than they were just months ago. Bank of America's Metals Research Division is talking about silver potentially reaching levels that would have seemed insane just a few years ago. These aren't fringe analysts. These are the major banks that have historically been conservative on precious metals, and they're all saying the same thing. Silver is undervalued relative to gold, undervalued relative to its industrial demand, and undervalued relative to the monetary chaos we're seeing globally. But here's what makes this moment different from past silver rallies. In previous bull markets, silver moved primarily on investment demand. People bought silver because they thought the price would go up. This time, we have something we've never had before. We have structural industrial demand that cannot be substituted away. You can't build solar panels without silver. You can't manufacture electric vehicles without silver. You can't deploy 5G networks without silver. This isn't speculative demand that can disappear overnight. This is real physical demand from industries that are growing exponentially. The math on this is actually pretty straightforward, and it's why 50 ounces makes so much sense as a target position. Let's say silver is trading around $70 to $80 per ounce, which is roughly where we are after the recent volatility. 50 ounces represents an investment in the range of several $1,000s. That's meaningful money for most people, but it's not life-changing money. It's not betting the farm. It's a strategic allocation to an asset class that has legitimate upside potential based on fundamental supply and demand dynamics. Now, what happens if silver goes to $100 per ounce? Your 50-ounce position is now worth significantly more. What if it goes to 150 or 200? Suddenly, that strategic allocation has become a substantial portion of your net worth. And here's the key. You didn't have to time it perfectly. You didn't have to catch the exact bottom. You just had to have enough exposure that when the move happened, it mattered. Compare that to someone who owns 10 ounces. Same percentage move, but the absolute dollar impact is 5 times smaller. They made money, sure, but not enough to actually change their financial situation. They're still going to work on Monday. They're still worried about the same things they were worried about before. The 50-ounce investor? They have options now. Maybe they take some profits and pay off debt. Maybe they let it ride and see where this goes. Maybe they rotate some into gold or other assets. The point is, they have meaningful capital to work with. There's a psychological element to this that's just as important as the financial math. When you own 50 ounces of silver, you're invested enough to pay attention, but not so invested that you're checking prices every hour. You're in the game, but you're not gambling. You can weather volatility because your position size is appropriate for your overall financial situation. This is crucial, because the investors who panic and sell at the worst possible times are almost always the ones who are either overexposed or underexposed. They're either so heavily invested that every move terrifies them, or so lightly invested that they don't have the conviction to hold through volatility. Let me tell you about the COMEX situation, because this is where things get really interesting for anyone holding physical silver. The COMEX is where silver futures are traded, and it's been the primary price discovery mechanism for decades. But something's been changing. The amount of physical silver backing those paper contracts has been shrinking relative to the open interest. What does that mean in plain English? It means there are a lot more claims on silver than there is actual silver available to deliver. Now, most futures contracts never result in physical delivery. Traders roll their positions or settle in cash. But what happens when a significant number of contract holders decide they want physical metal? We've seen glimpses of this stress in the market already. Premiums on physical silver have spiked at times. Delivery delays have occurred, and the spread between paper silver and physical silver has widened. For someone holding 50 ounces of physical silver, this is all good news. You're not exposed to the paper market's potential dysfunction. You own real metal that you can hold in your hand. The geopolitical situation adds another layer to this story. We're watching the global monetary system undergo its biggest transformation since the Bretton Woods Agreement collapsed. Countries are moving away from dollar dependence. Central banks are accumulating gold at record rates, and silver, as gold's more volatile cousin, tends to amplify these trends. When confidence in fiat currencies erodes, precious metals benefit, and when precious metals benefit, silver typically outperforms gold on a percentage basis. Think about what's happening with BRICS nations. They're actively working to create alternative payment systems that bypass the dollar. They're settling trade in local currencies. They're accumulating gold reserves. And while silver isn't getting the same headlines, it's benefiting from the same fundamental shift. As the world moves toward a more multipolar monetary system, hard assets become more valuable. And silver, as the most affordable precious metal with monetary history, is positioned to capture a significant portion of that flight to safety. Here's something that doesn't get talked about enough. The silver mining industry is not set up to respond quickly to higher prices. Unlike oil, where higher prices can bring new production online relatively quickly, silver mining has long lead times. Most silver is produced as a byproduct of other mining operations. Only about 30% of silver comes from primary silver mines. That means even if silver prices double, we're not going to see a flood of new supply hit the market anytime soon. The structural deficit continues regardless of price. This is why the 50-ounce position is so strategic. You're not trying to trade in and out based on short-term price movements. You're positioning yourself for a multi-year trend that's driven by fundamentals that can't be easily changed. The industrial demand is real. The supply constraints are real. The monetary uncertainty is real. And your 50 ounces gives you meaningful exposure to all of it, without requiring you to become a full-time precious metals trader. Let's talk about the retirement angle for a moment, because this is where a lot of people are starting to pay attention. If you're sitting on retirement accounts worth 6 figures or more, you're probably thinking about diversification. You're probably worried about stock market valuations. You're probably concerned about bond yields in an inflationary environment. And you're probably wondering what happens to your purchasing power over the next 10 or 20 years. This is where physical precious metals, and specifically that 50-ounce silver position, starts to make a lot of sense. It's not your entire portfolio. It's not even the majority of your portfolio. but it's a meaningful allocation to an asset class that has historically preserved purchasing power during times of monetary instability. And we are absolutely in a time of monetary instability, regardless of what the official inflation numbers say. Speaking of retirement accounts, if you're in that position where you have $100,000 or more in traditional retirement accounts, there's something you should know about. Gold IRAs allow you to hold physical precious metals inside your retirement account without triggering tax penalties. I put together a comprehensive guide on how this works, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. No sales pitch, just information. Because here's the thing, with everything happening in the markets right now, with the geopolitical instability, with the monetary policy uncertainty, having some portion of your retirement savings in physical assets that can't be printed or devalued by central banks might be one of the smartest moves you can make. All right, back to why 50 ounces is the number that keeps coming up. There's a historical precedent here that's worth understanding. Go back to the 1970s, when silver went from $1.50 per ounce to $50 per ounce. The investors who made life-changing money weren't the ones who bought a few coins here and there. They were the ones who accumulated meaningful positions before the move really started. They understood that silver was undervalued relative to gold. They understood that inflation was going to drive precious metals higher, and they positioned accordingly. We're in a similar setup now, except the fundamentals are actually stronger. Back then, silver's primary use was photography and silverware. Today, it's essential to the entire green energy transition. It's critical for electronics manufacturing. It's necessary for medical applications. The industrial demand base is broader and more durable than it's ever been. And on top of that, we still have the monetary demand from investors who see precious metals as a hedge against currency debasement. The recent volatility in silver prices has actually created an opportunity that we haven't seen in a while. When silver surged above $90, a lot of late-stage buyers jumped in at the top. They panicked when it pulled back. They sold at a loss. And now, with silver trading well below those highs, but still significantly above where it was a couple years ago, we're in this interesting zone where the weak hands have been shaken out, but the fundamental story hasn't changed at all. This is exactly when the 50-ounce strategy shines. You're not trying to catch the absolute bottom. You're not trying to time the perfect entry. You're building a position that makes sense regardless of short-term volatility. Because here's what we know. The supply deficit is real. The industrial demand is growing. The monetary uncertainty is increasing. And silver remains one of the most undervalued assets relative to its historical relationship with gold. Let me give you some perspective on that gold-to-silver ratio because it's important. Historically, silver has traded somewhere between 50 and 70 ounces of silver to 1 ounce of gold. Right now, even after silver's recent surge, we're still in a range where silver is relatively cheap compared to gold. If that ratio reverts to historical norms, and there's good reason to think it will, silver has significant upside just from that mean reversion alone, and that's before we even factor in the possibility that both metals move higher together. The 50-ounce position gives you exposure to both scenarios. If silver outperforms gold, you benefit significantly. If both metals move higher together, you still benefit. And if we see another pullback, you have a position size that's manageable enough that you can hold through the volatility without losing sleep. This is the definition of a strategic position. You're not over-leveraged. You're not under-leveraged. You're positioned appropriately for the opportunity. Now, let's talk about what happens next because this is what everyone wants to know. Where does silver go from here? The honest answer is that nobody knows with certainty. Markets are unpredictable in the short term. But what we can say with confidence is that the fundamental drivers for higher silver prices are all still in place. The deficit continues, the industrial demand continues to grow, the monetary uncertainty continues to increase, and the supply response continues to be constrained by the realities of mining economics. Major forecasting firms are projecting silver to trade significantly higher over the next few years. Some conservative estimates put silver in the mid-90s. More bullish forecasts are talking about silver potentially reaching levels we haven't seen since the Hunt brothers tried to corner the market. And while those extreme forecasts might or might not materialize, the direction is clear. Silver is undervalued, and the market is starting to recognize it. For someone holding 50 ounces, this setup is ideal. You don't need silver to go to $300 per ounce to make meaningful money. If silver simply returns to its recent highs, your position increases substantially in value. If it goes higher than that, even better, and if it takes longer than expected. You're holding a tangible asset that has maintained value for thousands of years. You're not holding a stock that could go to zero. You're not holding a bond that could be inflated away. You're holding silver. The storage and security aspect of 50 ounces is worth revisiting because it's one of those practical considerations that matters more than people think. 50 ounces of silver is manageable. It's not so much that you need a vault, but it's enough that you want to think about security. A good safe at home works fine. Or if you prefer, there are reputable storage facilities that specialize in precious metals. The point is, you have options, and the cost of storage relative to the value of your position is reasonable. Compare that to someone who accumulates 200 ounces or more. Now you're definitely looking at professional storage, which adds ongoing costs. Or you're taking on significant security risk keeping it at home. On the flip side, someone with 10 ounces doesn't really have a storage problem, but they also don't have a meaningful position. 50 ounces is that sweet spot where you have enough to matter, but not so much that it becomes a logistical headache. The liquidity question is related to this. When you go to sell 50 ounces of silver, you're a serious seller. Dealers will compete for your business. You can negotiate on premiums. You can choose between multiple buyers, and if you need to sell quickly, you can do it without taking a massive hit on the spread. This is important because one of the criticisms of physical precious metals is that they're not as liquid as stocks or bonds. And that's true to some extent. But when you have a meaningful position like 50 ounces, the liquidity is actually quite good. Let me tell you about something that happened during the recent price surge. When silver was climbing rapidly, premiums on physical silver went through the roof. People who wanted to buy physical metal were paying significant premiums over spot price because demand was so high. But here's what was interesting. People who were selling physical silver were able to capture those premiums. They weren't just getting spot price. They were getting spot plus a healthy premium because buyers were desperate for physical metal. This is one of the hidden advantages of holding physical silver. When demand surges, you benefit not just from the higher spot price, but from the increased premiums. And with 50 ounces, you have enough metal that those premiums add up to real money. Someone selling 5 ounces might make an extra $50 or $100 from premiums. Someone selling 50 ounces could make an extra $500 to $1,000 or more. Same percentage premium, but the absolute dollar impact is 10 times larger. The tax treatment of physical silver is another consideration that's worth understanding. In most jurisdictions, physical silver is treated as a collectible for tax purposes, which means it's subject to capital gains tax when you sell. The rates vary depending on how long you've held it and your overall tax situation, but it's something to be aware of. The advantage of holding 50 ounces is that you have enough of a position that tax planning makes sense. You can think strategically about when to sell, how much to sell, and how to minimize your tax liability. This is also where the gold IRA option becomes relevant for people with significant retirement savings. If you can hold physical precious metals inside a tax-advantaged retirement account, you get the benefits of physical ownership without the immediate tax consequences. It's not right for everyone, and there are rules and restrictions you need to understand, but for people with six-figure retirement accounts who are concerned about market volatility and currency debasement, it's worth exploring. Again, I've got a detailed guide on this in the description if you want to learn more. Let's talk about the psychology of holding 50 ounces, because this is where a lot of people struggle. When you own physical silver, you're going to watch the price fluctuate. Some days it'll be up, some days it'll be down. And if you're not mentally prepared for that volatility, you're going to make emotional decisions that hurt your returns. But here's what I've observed. People who hold 50 ounces or more tend to be more stable emotionally. Why? Because they've made a significant enough commitment that they've thought through their thesis. They're not gambling. They're investing based on fundamentals. Someone who buys 5 ounces on a whim is much more likely to panic sell when the price drops. They didn't really think through why they were buying. They just heard silver was going up and wanted to get in on the action. But someone who accumulates 50 ounces? They've done their research. They understand the supply deficit. They understand the industrial demand story. They understand the monetary hedge aspect. And because they understand all of that, they can hold through volatility without panicking. This psychological stability is actually one of the most underrated aspects of successful investing. The best returns don't go to the people who are the smartest or have the most information. They go to the people who can hold through volatility without making emotional decisions. And having the right position size, that 50-ounce sweet spot, is a huge part of being able to do that. The industrial demand story for silver is only getting stronger, and this is something that's going to play out over years, not months. The solar industry alone is projected to consume massive amounts of silver over the next decade. Every solar panel requires silver for its electrical conductivity, and as the world transitions to renewable energy, that demand is only going to increase. Electric vehicles are another huge driver. The average EV uses significantly more silver than a traditional internal combustion engine vehicle, and EV adoption is accelerating globally. Then, you have 5G infrastructure, which requires silver for its high-frequency applications. You have medical applications, where silver's antimicrobial properties make it essential. You have electronics manufacturing, where silver's conductivity makes it irreplaceable. The list goes on and on. And here's the key point. None of these industries can easily substitute away from silver. It's not like they can just switch to copper or aluminum if silver gets too expensive. Silver's unique properties make it essential for these applications. This is fundamentally different from silver's role in the past. When photography went digital, silver lost a major source of demand. But today's industrial applications are growing, not shrinking, and they're tied to megatrends like electrification and renewable energy that have decades of runway ahead of them. For someone holding 50 ounces of silver, this means you're not just betting on investment demand or monetary chaos. You're also positioned to benefit from real, structural industrial demand that's only going to increase. The supply side of the equation is equally compelling. Silver mining is not easy to scale up. Most of the world's silver comes from countries with significant political or operational risk. Mexico, Peru, China, Australia. These aren't exactly stable, predictable jurisdictions. And even in the best of circumstances, bringing a new silver mine online takes years and requires significant capital investment.